What are the themes so far for 2026?
According to the press releases and the data coming out from all federal sources and private sources, the theme is the third quarter GDP was the third estimate, I should say, of first quarter GDP numbers. That's first quarter of 2026 is 2.1%. Now that may sound weak. That's real. That's inflation adjusted. May sound weak, but that's pretty darn good. Probably one of the highest on the face of the globe. So that's better than we're going to see later on. GDP growth is much stronger than labor growth. So we're not growing jobs, we're growing the GDP. And of course, what we're seeing is if you take the elements of GDP, C plus I plus G plus net exports, the C is very weak. Consumers are not buying, and that's particularly on the low end, low income end. I is strong. Data centers, we're seeing a lot of investment there. But as I say before, you can't eat a data center. So that's not very helpful to most Americans out there. G is still strong. The government's still spending like, I want to insult, I was in the Navy as a drunken sailor, but I wasn't a sailor, but I was in the Navy and we weren't that bad. Imports were negative. So imports, that's, in other words, we're increasing imports and that's, well, actually the imports declined. So that's an issue going forward. Big drivers, the information industry, that would be what we call the fantastic 7 or 8 or whatever number you want to call. And those are growing, but I think that's limited. Those AIs, if you look at it, look at the stock market, the upturn is now in the small caps and the big caps not so much, just coming down, and I think it'll continue. The data centers growing, as I said, but even there, too much resistance. We're going to see data centers being capped across the nation. The negatives were finance and insurance, not so well. Wholesale trade, not good, because retail trade, not good. Again, the consumer is just not where they need to be, and that's a real concern going forward. Inflation is outrunning wage data. In other words, the inflation rate's higher than the wage growth rate. So we'll wait on August the 20th. The Fed is going to issue a statement on the reserve strategy. That's going to be very important. That'll probably come at the Jackson Hole summit that the Fed normally heads up in August. A rate hike, we'll probably see a rate hike on September the 16th and 17th when the Open Market Committee meets again. That's the Federal Reserve Rate Setting Committee meets on the 16th and 17th of September. I think there's going to be a rate hike, not because the economy is all that strong. The economy is not that strong in terms of jobs, but it's very strong in terms of inflation, too much inflationary pressures. I have to say it's a supply side inflationary pressures going forward. And that's a concern because the Fed is somewhat impotent when it comes to those, the supply side increases. And the Fed bias is certainly toward raising rates.
According to supply managers in the 9 Mid-America states, how is the economy performing?
July number was down a bit, 55.7. That's not bad. That's down from June's 56, but that's still in what I'll call a solid range, still consistent with a growing manufacturing economy, and that's, of course, good. It's the 6th straight month we've had a reading above growth neutral. Of course, 50 is growth neutral, below 50 is growth negative, above 50 is growth positive. So that's slightly above growth neutral. Is consistent with solid overall regional economic growth as it spills over into the broader economy, but still not strong enough to really get excited about. And we ask about the impact of the supply of Iran's, what's going on with the Iranian conflict or war, whatever you wish to call it. No change in orders. They indicated no change in, are they ordering larger supplies? No. 93% said no. 7% said yes, they had increased the size of their orders, to get a buffer for any downturn or any blockage. The trade numbers are moving sideways, but negative. They're still below growth neutral. Imports, 44.8, that's up from 44.1. So imports are still below growth neutral, still pulling back in imports. Exports, very important. Export reading 46.1, that's down from 47.3. The important part here is The Trump administration, despite what almost every economist, including yours truly, we don't agree with these tariffs. The president's going to enact more tariffs, and he's punishing our northern neighbor, Canada. I disagree with that. That's not good policy, at least from an economic standpoint. Here I'll bring up a chart showing the three surveys, two of which are done by Creighton University. The rural Main Street there in black, of course, it's down to 42.1 as you see, and that's for July. And as you look at the Mid-America, that one that I'm reporting on today, as you see the number there, 55.7. And of course, the U.S. number, the PMI, it's called Purchasing Management Index, is at 53.3. Now that's June. We'll wait till later on this morning to see what comes out from the National ISM survey of supply managers.
What were the hiring trends?
Wow, this is 51.2. That's July, and the reason I'm chuckling is because I talk about it as if that's good. That's only slightly above growth neutral, and that's up from June's 49.8. It's only the second time in the past 12 months that we've had a growth above growth neutral reading. U.S., and when you look at manufacturing, U.S. Manufacturing jobs still down 37,000 over this time last year. The regional manufacturing is down by 7.5 thousand, and that's negative 0.5%. The U.S. number is down 0.3%. And food processing job losses have slowed, but they remain. In other words, food processing jobs, still we had more job losses, but they were minimal for the region. So we're still seeing that food processing remains very weak in terms of manufacturing.
What inflation trends are you noticing?
Inflation is still elevated, although elevated at a lower rate. The price gauge was 71.4, and that's down from June's 78.3. That's still too much inflationary pressures. And the Federal Reserve announced last week, Warsh said, hey, we didn't raise rates. Well, good thing. But there were 3 votes to raise rates. 3 of the FOMC said raise rates. Now, I don't know if that included Warsh himself. I don't think that's the case. I believe he was one of those who said keep rates the same. So 3 members said raise rates. So we're on a rate hiking, at least agenda right now, but we'll wait and see. No rate hike though. Inflation remains well elevated, but this is supply side inflationary pressures. The oil prices, and the question is, do they feed through? And the real problem, and this sounds like economics, too much economics. It's the supply side inflationary pressures. What does that mean? It means that the Fed increases rates, that slows the economy. Well, they were already being slowed by higher oil prices. So those two compound, and what do you get? Stagflation. Now, we're not to stagflation yet, but that would be a movement in that direction. Supply deliveries, those terms of, they're at 59.5. That's above growth neutral, down from June 62.5. What that means is delivery speed is still slowing, and that's going to push up prices as well. And as I said, well, maybe I didn't say, the inflation rate remains well above the Fed's goal of 2 percentage points. That's year over year, and we're still well above that. In fact, we've been above it for 5 years now, so let's get used to it. The favorite measure, the Fed's favorite measure, the PCE, personal consumption expenditures, that's up 3.5 to 4% year over year. So it's hard to relax here if you're an inflation hawk, as Warsh says he is. Iran conflict, 64% indicated they delayed shipments because of increased cost. Okay, they indicated delayed shipments and increased costs, 64%. So costs have grown in addition to delayed shipments. Hope I made that clear. And the remaining same passed through, no changes, and that of course is the 36% said nothing's really changed here. So 64% said shipments have changed, the delays. 64% said they've absorbed increase in cost, and again 36% said no change here.
What is the economic outlook?
The outlook is continuing higher inflationary pressures. A bit lower though. They're going to, and that depends on oil prices, and of course, who can predict that? If you can predict what's Trump and Iran is going to do, those two parties, I would argue both have volatile statements. If nothing else, they say conflicting things, at least in my judgment. So it's hard to predict. But as long as oil prices remain in the 80 to 90 percent, $80 to $90, that's going to mean continuing inflationary pressures and continuing higher. Although again, like I said, I think inflationary pressures will come down a bit, but nowhere close to what the Federal Reserve's aiming for. They're going to still be year over year 3 to 4%, still too high. Warsh will allow the balance sheets to grow, a major issue. That's a big time. In his press conference last week, he talked a little bit about it, but not nearly enough. What that allows the Fed to do is inject dollars into the economy, and a lot, billions of dollars per week, that buying treasury bonds and injecting dollars. He said, and here's the deal. The deal is that all of us have become complacent. That's business leaders, economists, everyone. Well, the Fed will bail us out. And how will they bail us out? The balance sheet. That's how they did it last time, well, time before last, and last time, and next time too. In other words, everybody says, well, if we have a credit crunch, they'll bail it out. And I think that's what we're talking about, the balance sheet. Keep an eye on the Federal Reserve's other measures. That would, of course, be the credit standards and what they talk about in their press releases. But keep an eye on the number one thing is the bond market always. And all economists would tell you that, so I'm not any different from any other economist. The bond market's where the real action is. If yields continue rising, as you know, they've been rising. We're talking about a 10-year Treasury. It's been above 4.7% just recently. If it moves up to 4.7 to 4.8 to 4.9 to 5%, that's a real problem. That means more and more inflationary pressures. That means the Federal Reserve, much to my chagrin and everyone else's, they'll have to raise rates on announce a rate hike on September the 18th, which would mean the prime interest rates will go up by 0.25% the next day. That would be, of course, September the 18th. And the national ISM reading coming out later on this morning, that's important. Listen carefully to the statements by the FOMC members. I've said this many times, and I'm laughing. Why? Because they're not going to be making any. Warsh really does not want to do that, and he doesn't want them to do it. But there's one member who does it anyway, and listen to him, and that's, of course, Williams of the New York Fed and others. And on the February the 28th, the QCEW number. Now you say, what the heck is that? That's a census as opposed to the monthly surveys. And it's a census, meaning it's 11 million businesses. They'll tell us about growth in jobs in the first quarter of 2026. Very important. August the 7th, we'll know about the jobs numbers from the Bureau of Labor Statistics. That's the survey. Those numbers, I don't necessarily always believe them. Last numbers weren't good. 57,000, that's not enough. ADP numbers come out day after tomorrow, which of course is Wednesday. That number is private jobs. Those have been looking weak as well, weaker. So that's it for this month. Ernie Goss here with Creighton University, talking about our Mid-American survey of manufacturing supply managers in the 9 Mid-American states, stretching from North Dakota and Minnesota north, Oklahoma and Arkansas in the south. Until we meet again on the first business day of August, may your September, sorry about that. First business day of September, may your economic cup runneth over.